Alright, today is Sunday, February 14th, and you know what it is. It's Valentine's Day. Who loves you more than I do? Nobody. Who loves me more than you do? I'll tell you who. My mom, my dad, my grandpa, my grandma, my siblings, my uncles, my aunts, my cousins, my nieces and my nephews, my wife, my in-laws, my dogs, my friends, my coworkers, my clients, and then you. Anyways, we're doing a market review for the stock market activities on Friday and an outlook for this upcoming week. We have very interesting discussions during the headlines of the day segment. Very important macro discussion, and we will also talk about one of your favorite analysts, Tom Lee. I'll expose that guy for you once and for all. Let's not waste any more time because we have a long discussion ahead of us. Let's cover the market already. Here we go. The Dow Industrial Average closing in the green by 27.70 points or 0.09%. The Nasdaq in the green by 69.70 points or a gain of half a percentage point. The S&P 500 also in the green by 18.45 points or a gain of 0.47%. And what about the sector's performance for Friday? Leading the pack at number 1, capturing the gold medal, energy. Number 2 for the silver medal, basic materials. Number 3 for the bronze, financials. Meanwhile, the laggards of the day led by utilities, real estate, and communication services. Let's contrast that with the sector's performance for the week. Leading the pack once again, capturing the gold medal, energy. And number 2 for the silver medal, technology. And at number 3 for the bronze, basic materials. What about the laggards for the week? Led by utilities, the only sector closing in the red for the week. We saw yet again a massive surge in yields. When yields climb higher, utilities become less and less attractive because, traditionally speaking, utilities are looked upon by investors as treasury yields alternatives. They are the closest you can get to risk-free. Anyhow, moving on to the futures market performance on Friday, we saw massive gains for crude oil, whether we're talking about the WTI or Brent, both surging significantly, and you saw a big squeeze happening on Friday for energy names. What about softs? The gainers of the day led by coca, cotton, OJ, and lumber futures. Meanwhile, the laggards of the day led by sugar and coffee. What about metals? We saw gains for palladium, silver, platinum, copper. Meanwhile, mighty gold is lagging once again and closing in the red. What about meats? Gains across the board, whether we're talking about live cattle, feeder cattle, or lean hogs, all closing above 1% for the session. What about grains? Massive gains for canola futures, and keep that in mind, because we're going to discuss that during our macro discussion for the headlines of the day segment. Unbelievable gains for canola and the rest of the grains. We saw gains for soybean oil, wheat, soybean, and oats futures. Meanwhile, the laggards for the day on Friday led by rough rice, corn, and soybean meal futures. Moving on to the big casino, the options market. Let's see what happened on Friday. Leading the pack, per usual, the hottest table in the casino, Apple, with 1.3 million contracts trading on Friday. About 68% of those were calls. Coming up in number 2, the second hottest table in the casino, Tesla, with a little over 1 million contracts exchanging hands on Friday. About 52% of those were calls. And at number 3, Sundial Growers, with a little over 1 million contracts. About 71% of those are calls. I am done with my trade for this name. I dumped all of my shares for a massive profit, and we're done. But on Friday, I heard the geniuses over at CNBC talking about this name and what's going on with the REIT stocks. And their options guy, Nigerian, suggested buying the stock and selling upside call options because the stock is too cheap and you are supposed to use the elevated premiums in your favor by selling upside calls. This is exactly the same strategy that I talked about a week ago. Now the geniuses at CNBC are catching up to it after the move is already done. Perhaps there's another leg here, but I do believe that this was a pump and dump, and the opportunity here has passed already. Notable in the activities for the options market, Churchill Capital Group. What is that? That's a SPAC, the ticker CCIV. And the reason why the Robin Hoodites and the likes are stampeding to buy this name via options sometimes, as you're seeing right in front of you, is the fact that it is rumored that Lucid Motors, the competitor of Tesla, will go public via merging with this particular SPAC. The management over at Churchill Capital certainly has connections with Lucid Motors. However, it is just an assumption. You don't know whether that's going to happen or not. For all we know, the company is right now an empty shell company that's only selling a hope and a dream that Lucid Motor will merge with it. Furthermore, the stock is already trading at $40 almost, so the opportunity here is already gone. Most people who are buying this name don't understand how SPACs work, and they're making an assumption that Lucid Motors will certainly go to the public market via merging with this SPAC. It might happen that way, but it also might not happen, and this is the risk you're taking gambling with this name. And what about the unusual activities in the options market that took place on Friday? Starting with the ticker LI, this is for Li Auto. And you have noticed that we are seeing a significant surge in the options activities for this particular name. They're expecting a big move one way or the other. And in this case, it is a bearish bet buying the 26 puts, expiration date March 19th, with expectations that Li Auto will decline over 18% by then, and they are paying about $1 a piece to enter this trade, which brings the total to a little over $1.3 million. And what about this trade for the ticker KWEB? This is the Chinese Internet ETF, and somebody's making a bearish bet on this one, buying the 93 puts, expiration date March 19th, with expectation that the name is going to decline over 9% by then, and they are paying about $1.55 each to enter this trade, which brings the total all the way to about $2 million. What about this trade for the ticker UFS? This is for Domtar, and this is a paper mill company. In this case, they are making a bullish bet buying the $40 calls, expiration date March 19th, with expectation that the name is going to rally over 12% by then, and they are paying about $1 a piece to enter this trade, and that brings the total to about $1 million. Here's another interesting one for the ticker CLX. This is Clorox. Somebody's buying the 200 calls, expiration date March 12th, with expectation that Clorox will gain over 7.5% by then, and they are paying about $1.60 a piece to enter this trade. That brings the total all the way to about $700,000. And what about the trade at the bottom of the table for the ticker YETY? This is for Yeti. Somebody's making a bullish bet here by buying the 77.5 calls, expiration date March 19th, with expectation that the name is going to rally over 6% by then. And they are paying about $3.15 a piece to enter this trade. That brings the total all the way to about $1.3 million. Continuing with interesting trades. Here's one for the ticker HUN. This is for Huntsman Corporation, a name that I used to invest in back in the day. This time around, somebody's making a bearish bet buying the 26 puts, expiration date March 19th, with expectation that Huntsman will decline over 9% by then, and they are paying about $0.50 a piece to enter this trade. That brings the total all the way to about $175,000. Here's another interesting one for the ticker QS. This is for QuantumScape. We saw a massive surge for this name on Friday, and the reason is the geniuses over at Morgan Stanley decided to upgrade the stock. Let's stop here and let me teach you something. Here's a tweet I issued 4 days ago, before Morgan Stanley decided to upgrade the stock. Matter of fact, 2 days before they did. I told you that QuantumScape is rising from the dead. They're buying calls right now. And this was your hint to go ahead and buy some QuantumScape calls. Why did I issue this tweet? Number one, I was watching the call options volume for QuantumScape, and we saw a significant uptick higher. Number two, if you look at the chart, the name has been dormant for a while, and we saw a positive crossing in the MACD, signaling an upcoming positive momentum for the name. Now here is the truth for you. These geniuses over at Wall Street, the analysts, this time around from Morgan Stanley, they're looking at exactly the same chart and facts I just told you. And when things align and it becomes obvious that the stock is about to explode higher, they issue their upgrade to give the illusion that the stock is rallying based on their calls and that they got it right and they know what they're doing, etc., etc. They get all the credit for the movement in the stock. Meanwhile, the call options buying started days before that. We saw the positive crossing in the MACD also happening days before Morgan Stanley decided to update. It is a sneaky business unless you are paying attention. Back to the trade. In this case, somebody's buying the 65 calls for QuantumScape, expiration date February 26, and they're expecting the name to rally over 19% by then. And they are paying about $4 a piece to enter this trade. That brings the total all the way to about $1.5 million. And here is the last trade of the day, also moved based on Morgan Stanley's recommendation. They've upgraded QuantumScape, but they've downgraded this name, which happens to be Lordstown, the ticker RIDE. And somebody's making a bearish bet here, betting on a continuation of the downward movement for this name by buying the 25 puts, expiration date April 16th, with expectation that the name is going to decline over 7% by then, and they paid about $4.30 a piece to enter this trade, and that brings the total all the way to about $1.3 million. Moving on to the headlines that shape the day, starting with macro news. And here it is. U.S. consumer sentiment drops to the lowest level in 6 months. No biggie. Stocks are just going to go up. No problem. But here are more details for you if you are still interested. The University of Michigan survey. Among those with incomes in the bottom third, just 23% reported improved finances, the lowest since 2014. And in the report, we found out that the inflation expectations among consumers have risen to the highest level since 2015. So when bond bulls keep telling me, oh, why you're talking about bonds going lower and yields rising higher, it is all about inflation expectations, let alone the actual inflation that we have in the economy right now, specifically in commodity prices. But we can have an inflation crisis based on the psychology alone. And this is a good stop for us to talk about the Federal Reserve and Jerome Powell. The Federal Reserve is a very confused organization. They've been pushing interest rates lower and lower and lower. Meanwhile, inflation has not risen at all in the past few years. Meanwhile, the unemployment rate fluctuated up and down, but pre-pandemic, we have reached the lowest unemployment rates for a long time. So we had low inflation and low unemployment. That makes you question the validity of the Phillips curve, because the question for the Phillips curve was always the chicken and the egg. Does higher inflation lead to lower unemployment, or does lower unemployment lead to higher inflation? The genius economists, the zombie economists really, always assume that a lower unemployment rate would lead naturally to higher inflation, and therefore they've always tweaked their policies to keep the unemployment rate from being too low for the risk of inflation. But after the pandemic, Jerome Powell made a public speech and declared that the Federal Reserve is abandoning the Phillips curve. And matter of fact, they will let inflation rise higher to recover the unemployment picture. So the Fed is very confused here. On one hand, they're saying we abandon the Phillips curve, and to remedy that, they're actually adapting the Phillips curve once again. Because if you're assuming that higher inflation will lead to lower unemployment, you are still a believer in the Phillips curve. But this is the power of the Fed's hash, which we know that Jerome, Kaplan, and Bullard, at least these three, are smoking daily. So their brain cells don't function anymore. They open their mouth and they say the dumbest statements ever. And these are the people we trust to hold the central banking policy of not just the United States of America, but the entire globe. And now the very confused Fed is heading into another confusing and difficult challenge. If your assumption is that letting the inflation rate rise higher will improve the unemployment picture in the country, then you're also assuming that Treasury yields are gonna go higher to adjust for inflation. But no. The Federal Reserve and Papa Jerome, they want their cake and they wanna eat it too. Papa Jerome believes that he can control and engineer everything in the economy the way he likes, and there are no consequences whatsoever. Now that we're seeing inflation rising higher, and we're talking about the bullshit formula that the Fed uses, the CPI and PPI. Meanwhile, me and you know already that inflation is skyrocketing. The real rate of inflation is mind-blowing. And you don't need to look further than commodity prices, housing prices, and equity prices in the stock market to know that we are in a very, very high inflation era. But the Federal Reserve likes to use their own fugazi, outdated formula, so we will be open-minded and use that as well. But even with that measure, inflation is rising higher, and as inflation started to pick up, Treasury yields also started to pick higher. And the unemployment rate has improved according to the latest jobs report, which is fake by the way, and I'll expose that to you in a second. But let's just assume that it is correct and take it at face value. Papa Jerome's mission is going according to plan. He's letting inflation rise higher, and as a result, unemployment is being reduced. So we should all be happy, right? Wrong, because Papa Jerome and the Federal Reserve don't want to see a surge in Treasury yields. Why is that? Because a surge in Treasury yields will crash the stock market. And remember, the Federal Reserve's secret mandate and only mandate is to protect, prop up, preserve, and inflate the assets of the wealthy, stocks, and real estate. And this is the dilemma that the Federal Reserve is battling with. If we want inflation to rise higher to recover the unemployment picture, that's good, but we also don't want Treasury yields to rise higher. They want their cake and they want to eat it too. It is a very, very confused organization. So what Papa Jerome figured is, let me lie, let me fabricate things and try to manipulate the market the way I want it to. So last month, they released the Fugazi jobs number showing us that the picture is a little worse than we expected. At the same time, they released the fake CPI report that the Federal Reserve uses to measure inflation. And the Fugazi CPI showed that inflation is steady and it's not rising higher. Why is the Federal Reserve, in coordination with the Bureau of Labor Statistics, issuing fake numbers to manipulate the market? Here it is. And once again, remember, the Federal Reserve is a very confused organization. Papa Jerome thinks that if he lies to us, if he plays poker and releases fake data showing that the economy is not recovering as fast as we expect and that inflation is not rising as high as we expect, we will be under the assumption that the Fed's bond purchasing program will not be tapered anytime soon. Matter of fact, in his latest interview, Jerome Powell insisted over and over again that he will not taper bonds purchases anytime soon. Of course, the goal from all of this fabrication and this propaganda mission since the release of the CPI report is to tell the market that the Fed will continue to buy bonds, and that will push bond prices higher and Treasury yields lower, meaning that the Federal Reserve will not take its foot off the pedal of the cocaine operation anytime soon. It will continue to do quantitative easing, and it will continue to supply the market with cocaine as long as it's needed. And of course, that should translate into lower Treasury yields. And after the CPI report and the interview with Jerome Powell, we saw Treasury yields diving lower. Mission accomplished, right, Jerome? Wrong. Because the market is reading through his lying teeth, and because he's a shitty poker player, yields reverted and surged higher once again. Matter of fact, we saw a massive pump on Friday, meaning that the market is not buying Jerome's market manipulation attempts. Why is that? Because, and this is the genius of Jerome Powell, by the way, when you tell the market that you're not going to taper bond purchases anytime soon, and you're going to continue to supply the cocaine to the market, you're basically telling us that inflation is going to rise higher because you're going to throw more and more and more cocaine, aka the money supply, the monetary stimulus, to the market, and that would lead to higher inflation. So the market initially dropped yields lower and then reverted higher, saying, well, wait a minute, if Jerome wants to manipulate the market lower in terms of yields by telling us that he's not going to stop buying bonds and he's going to continue to supply the market with cocaine, that actually would mean that inflation would rise higher than before. And you saw yields surging on Friday. And Papa Jerome looks like a total jackass right now. He is a very confused individual. And let's hear more color about this subject from Danielle DiMartino.
But first, I think it's all about the man of the hour, and that's Jerome Powell. He's speaking at the New York Economic Club this hour. We're going to bring you those headlines as the Federal Reserve charts a course into new waters that many say will only lead to doom. Higher inflation, exploding financial bubbles, even wider income inequality. Here now to discuss two brilliant and passionate Fed watchers, Quill Intelligence CEO Danielle DiMartino Booth, along with Walzer Wealth Management President Rebecca Walzer. Hey, let's start with this CPI report this morning, right? Because that's the official report card on inflation. It was benign. They said there's no evidence of inflation. Danielle, seems to me, though, that these reports, they only embolden Powell and company to keep the printing press going, maybe for years to come. Your thoughts?
They certainly do. Charles, we have to keep in mind that Powell and company, as you say, they only look at the core CPI. And the core CPI, of course, only applies to central banking models. It certainly doesn't apply to our cost of living and the price pressures that we see. Somebody sitting here who buys a gallon of milk every other day, I can tell you for darn sure that I don't live on the core CPI. But you're right. The lower these prints are, the easier it is, the greater the license that the Fed has to say, we're going to hide behind these bad models. Again, these are not true metrics of the price pressures that American households are shouldering, but we're going to be able to hide behind them and say, we've got to keep printing money until we can get it up to this 2% arbitrary target. So, but Charles, as I've been saying for months, the Fed needs to be careful looking out into 2021 over the horizon about getting what they're asking for and getting those higher prints. There's a risk building for that.
Danielle, with this new mandate, because essentially what they're saying in the past, if there was 5% unemployment and you stripped out white unemployment, that would be significantly higher for other pockets of our society. So this time around, they're going to make sure that everyone has full employment. And that certainly means perhaps inflation at 2.5%, 3%.
Well, Charles, I mean, the way you just described the situation in and of itself it's inherently conflicting. Trying to get inflation up, trying to get households' cost of living up, that doesn't help them at all. And the Fed is limited, inherently limited, because they don't only have so many tools in their toolbox. Right now, what they've got is the ability to run the printing press in the background. The transmission mechanism, the way we see Fed policy manifest, is in the stock markets. It's in people taking risk, but who have access and who have ownership of homes and of stocks. That currently, it is simply not. The Fed may be noble in its aims. I'm not trying to take away from that or discount that. But right now, the Fed does not have the tools to address inequality, and the risk is that they're going to end up inflating yet another asset bubble.
I've got breaking news from this Powell thing at the New York Economic Club. One thing he's saying is that the real rate of unemployment in this country is not 6.3% that's being reported. It's more like 10%. Again, reason for the Fed to keep the pedal to the metal when it comes to the printing press.
Did you guys catch that one? The Federal Reserve just admitted that the real rate of unemployment is actually over 10%, rather than the Fugazi print they gave us during the jobs report last month, which indicated that the unemployment rate is hovering around 6%. Are you kidding me?
Fed Chair Jerome Powell painted a bleak picture of the labor market, Melissa, and how far the U.S. has to go to get back to where it was, and also connecting that to a very strong case to keeping the Fed's easy monetary policy in place. Powell will say the Fed will maintain a low target rate until employment and inflation near their goals. The Fed will also maintain asset purchases at $120 billion per month. And it will not tighten solely in response to a strong job market. It says we are a long way from a strong labor market, and the labor market recovery requires continued policy support.
See, when I talk about cooking the books and that the jobs report is fake, people attack me and say, oh, you're just making propaganda and the conspiracy theories. The books are cooked. This is your proof. Why is the Federal Reserve all of a sudden telling us that the actual unemployment rate is at 10%? The reason is they want to give us the illusion that they will continue to ease, they will continue to buy bonds, and yields should not panic higher. It's not working. Jerome is very confused. He has no clue what he's doing. He wants to balance between the public mandate, this is the mandate that they give us, that the Federal Reserve has a mandate of reducing or balancing employment in the country. And right now we have high unemployment. So the Federal Reserve has to do something to push it lower. And their plan to do that is by letting inflation rising higher. However, there is a conflict with the public mandate versus the secret mandate, which is to prop up and inflate the assets of the wealthy, specifically the stock market, and therefore they don't want yields to rise higher. Here is economist Mohamed Al-Arian.
Final question, Mohamed. Market-based in the bond market right now at 4 basis points on 30s, almost 2%, on a 10-year up to about 119. Look, a year ago, 2 years ago, 3, 4, 5, 10, 20, 30 years ago, these are levels which were just unheard of, Mohamed. The level we're at right now, do you have a bite point in mind for this market where you think things start to get tested, when yields start to compete for capital elsewhere? It can't be 120. What is it in your mind?
So if we get to 150 by the end of the week and by the end of the month, and that's not difficult, you know, we saw what happened at the beginning of the year, then that will be disruptive to the market. If we slowly go up and we're at 125, 130 by February, then it will be the same conditions that we see today.
And bingo, there it is. If the 10-year Treasury yields rises higher with the velocity that we have seen earlier in the year, that would crash the stock market. The Federal Reserve acknowledges that yields will eventually rise higher, but they want that process to happen gradually for their owners and overlords at Wall Street to plan the exit from equities accordingly. They don't want to get caught with their pants down, and we see a massive crash in the stock market out of nowhere. And this is why Jerome has been on overdrive this week, attempting over and over and over to calm down the surge in yields. It is not working so far, and as Mohamed Al-Arian acknowledged, if we see a massive surge to 1.5 by the end of the month, game over, baby. And remember when Jerome Powell was asked about equity prices reaching extremes and bubble territory, and he said that that doesn't matter because valuations don't matter right now, and he gave the low Treasury yields as a reason to justify the high PE multiples. Here is the chart back in April 2020. The gap between the S&P 500 dividend and the 10-year Treasury yield was at the widest for a long time. The line in orange indicating the dividend yield for the S&P 500 at around 2.5% at the time. The blue line indicates the dividend yield with a 10-year Treasury at about 0.5 percentage point or so. At that time, that was a buying opportunity of a lifetime, really. It was a no-brainer that you have to buy stocks because the risk-free rate is not worth it. Now, let's fast forward to where we are right now. And here it is. The S&P 500 dividend yield is trending lower, below 10% for the first time in a very long time. Matter of fact, the first time in decades. Meanwhile, the 10-year Treasury yield is rising higher. And once you see that crossing, the market, of course, not going to wait till the crossing to happen. If the market senses that the crossing will happen, you will see an epic, and I'll repeat, epic market crash. And I know what you're going to say. You're looking at the chart and you're saying, well, wait a minute here. the 10-year Treasury yield always been higher than the S&P 500 dividend yield. So what is the big deal here? The big deal is that the S&P 500 dividend yield will pay lower than the 10-year Treasury yield at a time when the S&P 500 valuation is at all-time highs. It is an extreme bubble territory. From price to earnings perspective, from price to forward earnings perspective, from a discounted cash flow perspective, from a price to sales ratio perspective, we are at the most extreme valuations ever. So if the risk-free rate is higher than the S&P 500 yield, and it need not to be higher, it just needs to be close. When it gets that close, the question will be asked, why should I hold on risk at bubble territories when the risk-free rate is going to pay me pretty much close to what I'm getting paid right now? And remember, the market looks forward, so it's not going to wait till the crossing happens. The move will take place as soon as we get a clear indication that the 10-year Treasury yield will reach over 2% by the end of the year. Now, while we're at it, what about the S&P 500 dividend yield versus the AA corporate bond average yield? Well, now the AA bonds are paying more than the S&P 500 dividend yield. Once again, the risk-free rate is higher already than the S&P 500 dividend yield. It is not worth it to take the risk, specifically given that we are at all-time highs valuations. And what about the NASDAQ, the high-growthy names that will get crushed the most from the rise in yields? Here it is, the 10-year Treasury yield yielding almost double what the NASDAQ 100 dividend yield is reading right now. And here it is, the bond market's bullish case for stocks is getting weak. Yields are at levels that rival dividends on equities, complicating the income equation for investors. For the better part of the past 10 months, investors have justified the huge melt-up in equity prices in the face of economic and social hardship from the COVID-19 pandemic with three simple words: but bond yields. I know this in part because I made that exact argument in early September in a column that ended up coinciding with an all-time high for the S&P 500. It showed that dividend yield on the S&P 500 and even the NASDAQ 100 were reliably above the benchmark 10-year Treasury yield, indicating that equities still had plenty of relative value when compared with the world's largest bond market. Fast forward 5 months, and that case is no longer nearly as compelling. The S&P 500 is up more than 8% since September, pushing its earnings yield to a record low of 3.16%. The NASDAQ 100 has gained 9% with earnings yield of 2.5% and dividend yield of 0.72%. Meanwhile, the 10-year Treasury yields have almost doubled to 1 and 14%, make that 1.2% by the closing on Friday. And the 30-year yield are closing in on 2%. The yield on long bonds now exceeds the S&P 500's dividend yield by the most since before the COVID-19 pandemic reached U.S. shores. Now, many investors wouldn't make that specific trade-off, given the huge level of duration risk involved in owning the longest dated treasuries. But consider this instead: a Bloomberg Barclays index of AA-rated corporate bonds with an average maturity of 13 years, featuring companies like Apple, ExxonMobil, Visa, and Walmart, yields at 1.6%, the highest since June. That too exceeds the S&P 500 dividend yield. Regardless, markets are fast approaching the point at which the call between stocks and bonds is no longer a no-brainer from a pure income perspective. Equities obviously still offer more upside. Even bond traders are willing to admit that. But the days of stocks beating bonds at their own game appear to be numbered. And here is the ticking bomb that would act as the nail in the coffin of the equities market. Take a look at the M2 money supply, rising exponentially to cartoonish levels. And the question was, if we have this massive surge in M2 money supply, how come we're not seeing inflation, at least in the Fugazi Fed data? We know that the inflation all around us. We go to the grocery store, we fill our vehicles with gas. We know that inflation is way higher than we are told. So why hasn't inflation showed up in the Fed's radar? The reason is the collapse of the velocity of money. All you need is just a slight uptick in the velocity of money and you will see inflation exploding higher. Why haven't we seen the velocity of money rising higher? The reason is we are in a shutdown, lockdown, whatever you want to call it, and money is being saved and not spent. Once the economy reopens after the vaccination, that money will move from bank accounts and exchange hands in the economy, thus accelerating the rate of the velocity of money. You just need a little bit, just a tiny bit, and you will see inflation skyrocketing, giving the level of M2 money supply. And by the way, while we're at it, how does inflation helps the unemployed, the poor and hungry, and the middle class when you make their wages that, by the way, haven't increased for a while and never kept up with inflation? When you make those wages have even less purchasing power. Here's what happened. We turned into a welfare state with extreme poverty and hunger. The US has 20.4 million people receiving unemployment benefits, a sign of ongoing hardship and lack of job opportunities. Furthermore, we do have a child hunger crisis in America.
This is no ordinary walk to school, because you won't see Shauna Gray's 3 children, or how she usually gets them dressed, packs their backpacks, and packs their lunch. Because in this pandemic, there is no school, and there is no lunch, unless she makes this walk. A 90-minute journey one way.
For my children, it's all worth it, and I wouldn't change a thing.
For free lunch, which means dinner too.
You are a blessing to me and to my family.
It's a time Shauna never imagined would get this bad.
Sometimes embarrassing, but it's what you have to go through.
If that wasn't enough, we have a seniors hunger crisis in this country as well.
Before the pandemic, there were an estimated 5.3 million hungry elderly in America. That number is rapidly growing. Here in New York, City Meals on Wheels will deliver hot meals to 20,000 of them today and every day.
Hot food right here. Oh my goodness. Oh, it smells so good.
Yes. First stop, 93-year-old Dorina Eduarte. She lights up when she sees Andrew. Andrew is deeply involved with the people he brings a meal and a smile to.
Bye-bye, Andrew.
Even timing deliveries to medication schedules.
Perhaps the Federal Reserve is starting to give up. They're starting to figure out that all of their manipulation efforts will not be fruitful. And at the end of the day, if they want to recover the economy, just like I mentioned in a previous video I made in this channel, you have to kill the bull. To save the economy, the Federal Reserve will have to sacrifice this stock market. And this leads us to this piece of news we heard on Friday. The Federal Reserve to test banks' ability to withstand 55% fall in equity prices. Why are they demoing this right now? They want to make sure that Wall Street will be ready when the Federal Reserve decides to pull the plug. And of course, that will happen with coordination with the Wall Streeters of the world, the big hedge funds, billionaires. They're all going to get the memo that the market's going to crash and it is time to pull out. Who's not going to get that memo? Retail traders and investors, specifically the dumb new generation of investors who we call the Robin Hoodiots, are so arrogant and believe that stocks only go up and should not care about valuations, fundamentals, anything at all. Just put your blindfold on and buy. Those people are gonna get buried. They will be the casualty when this whole charade is over. And to give you a sample, let's move on to sentiment news. Starting with this, here's a donkey giving his opinion. People like to say or like to make the analogy that this is like 1999-2000. I think it is different. The most dreaded words in stock market history. Never say this time is different. Anyways, in 99, most of the companies that were going up had no earnings. That is not the case today. And here's another donkey supporting him. Absolutely true. So many differences between then and now. An accommodative Fed is also a big difference. In 1999, the Fed was tightening. Not true. Not true. Why? You don't have Google? You couldn't Google what the Fed was doing? You don't remember the Maestro, Greenspan? But this is the magic of social media. Any moron could have a voice and spread their opinions any way they want. Continuing, credit markets under a ton of stress and the overall economy was heading into a recession, not coming out of one. It's laughable if it wasn't sad. The economy was not in a recession back then. It was a tech bubble that crashed and the rest of the stock market did just fine. We are in a recession right now. The Federal Reserve itself just admitted that the true unemployment rate remains above 10%. These donkeys will get slaughtered and they're not going to even realize what happened. And here it is to address the no earnings thing. The percentage of IPOs with negative earnings per share at 80% right now, almost exceeding the highs of the dot-com bubble. Here is more. The percentage of Russell 2000 companies with negative operating earnings at almost 35%, exceeding the levels of the global financial crisis and the dot-com bubble. It was more in sentiment news. Stock trading frenzy sends U.S. volumes toward peak panic levels. It was the retail volume, now commanding over 30% of the overall volume in the stock market. Oh, but it's not like 1999. Give me a break. And it's not just retail that are losing their minds, but it's also institutionals. Here's the 2021 S&P 500 forecasts. JP Morgan at 4,400, Goldman Sachs 4,300, UBS 4,100. Why not? Just keep shooting these numbers higher and higher. Who cares? Who cares? They're losing their minds, all of them. Here is more on the institutionals. Investors poured a record amount into equity funds, especially tech stocks, prompting strategists at Bank of America to warn the exuberance may precede a correction. Stock funds had inflows of $58 billion in the week through February 10th. Continuing. The rush to equities saw extreme positioning among the U.S. investment bank's wealth management clients, with 63.1 allocated to equities, the highest ever, and 19.1% to debt, the lowest ever. They're going all in, Naruto style, with the blindfold on, heads first, buying the riskiest assets. The market has turned into a casino. On what about the margin debt mania? Here's an update for you.
I'm about to bet $100,000 on a risky stock option day trade. Worst part of it all, I'm gonna borrow the money. Please don't try this at home, but I just turned on margin trading on my account, which means I can now borrow money from Robinhood. Just analyze the charts, and it's looking like there's about to be a bullish reversal on the Tesla stock for the day, so we're gonna go ahead and go in with some call options. I already know we're trying to buy low, sell high. Okay, my bad. I guess for options trading, unfortunately, Robinhood is only letting me borrow 70 grand.
70 grand on the line, swipe up to submit.
Knees weak, palms a little sweaty. We are now down $2,000.
Earnings check? Oh, we have none.
I might have to get a real job after this.
Hey, I was just wondering what your guys' hiring process is like.
We've been fluctuating up and down for like the last 30 minutes, but if you look at the graph right now, we have a pennant pattern going. I think this is about to break out. I really just called it. We're up by 2 grand right now. Am I gonna sell though? Absolutely not. We're now up by 5 grand. I'm not gonna be greedy. Gonna take the 5 and do a celebratory kickflip.
Just a healthy, functioning market. And here is the volume for call options exploding higher to levels that we have not seen during the dot-com bubble or even before. Never seen before. The biggest bubble of all time. On what about our friend Mark Cuban, who's egging all of these retail investors to continue with their stupidity, specifically in GameStop stock?
And what about the massive rise of retail? I've seen you on Twitter talking about it. We've all been looking at this. The huge rise of retail, which is great, but it seems like it's come very quickly with stimulus checks, and it seems to be driven by other things as well. What's your take on that whole situation?
I love it, right? Because it's the revenge of the nerd. It's the revenge of the little guy, and it's no different. It's just using some of the same techniques that brokerage firms have used forever. Get long and get loud, except now in this day and age, you can go on a message board, but unlike the internet days when there would be a few thousand people on Yahoo message boards, or maybe 100,000 people on message boards across a variety of stocks, now you've got Wall Street Bets and the like, where you've got this concentrated effort, and you've got the zeitgeist, this mindset of screw the big guy, right? Screw Wall Street, and you combine those two together, and it's not investing. And it's almost not even trading. It's more like revenge, and it's not necessarily a bad thing.
And of course, Mark Cuban has lost his mind. He's totally irrational right now. I don't know what he's smoking, what he's drinking, what's going on with him. But his brain cells are gone, and they're never coming back. I used to look up to this guy. Now he's just an asshat. Tell me again, Mark Cuban, how this is a win for the retail investor, and how they're sticking up to Wall Street. Sticking it to the man. The Wall Street Journal, GameStop mania is focus of federal probes into possible manipulation. Justice Department has subpoenaed information from Robinhood Markets and others. It sounds like the retail guys were a smokescreen for real professionals, doing the professional hardball warfare that has always existed, and the only difference this time is there was a retail smoke screen in front of them, said Mr. Friedman, who was previously general counsel of an electronic trading and trading technology firm. If an investigation were to show that a few key individuals instigated the whole effort, that could buttress a manipulation case, according to securities lawyers. However, charging hundreds of defendants who traded in small increments and believed they were roaring with hedge funds wouldn't be viable, the lawyers said. We now know they're finally catching up to what we've been saying in this channel. This was an inside job. The whole story that they sold us about the Reddit warriors and the retail traders fighting back, it's all bullshit. It was an internal war between rival hedge funds. These donkeys over at Wall Street Bets were just the front. And let's segue back to the whole comparison with this bubble with 1999. Here's the article from Forbes magazine. Is the stock market about to crash? And they compare certain indicators for the market right now at these levels versus 1999. Let's see if this time is different or similar or even worse, starting with the S&P 500 chiller ratio. The current reading is 35. Meanwhile, during the dot-com bubble, it was reading at 44. So we're still overvalued, but not to the magnitude of the dot-com bubble. What about this one? The American Association of Individual Investors Sentiment. This is what Tesla witch Kathy Woods uses to justify saying that this is not a bubble. The current reading is at 46%. Meanwhile, during the dot-com bubble, the reading was 75%. So we still have some room to go here, according to this particular indicator. Here's the next one, the Volatility Index, the VIX. And of course, this is the average reading for last year next to the dot-com bubble. And it says its peak so far this year of about 37 has already eclipsed the high of 33 in 2000. So from a VIX perspective, this bubble is way bigger than 1999. Here is more. The S&P market cap concentration and the rating we have right now at 21% versus the dot-com bubble at 18%, meaning that we are more concentrated in this current bubble when you compare it to the 1999 dot-com bubble, meaning that the crash for this one will be epic due to the ETFization of the market and the concentration of positioning in very few names. What about the personal savings rate? The current rate is at 13.7%. The rating during the dot-com bubble was at 4.5%. Here is the catch though. Once COVID subsides and life returns to normal, consumer spending could snap back with a vengeance, which bodes well for the economy and possibly, underline possibly, the stock market, though it has already benefiting from increased consumer wealth. Here is where I disagree with this article. If the current savings rate will translate into more spending in the economy, I just showed you the chart of M2 money supply versus the velocity of money. If the velocity of money increases higher, inflation will skyrocket, leading to much higher treasury yields, which will lead to a crash in the stock market because the valuations will not make any sense. So they say it's bullish. I think it is bearish. What about IPOs? A bullish stampede of initial public offerings, many with names ending in .com, was a hallmark of the 1990s technology bubble speculative frenzy, with an average 500 public market debuts each year from 1995 to 1999. Wait for it. In 2020, there were 538 IPOs, including 248 SPACs, themselves a frothy indicator. Average first-day returns in 2020, including the likes of Uber, Airbnb, were 35% compared to 75% average first-day boost in 1999. However, the first-day returns for SPACs, which are shell companies in search of business, may have muted last year's average. What about the Buffett indicator? In 99, we were rating 159%. The current reading is 195%, the highest ever, showing you that the market, the stock market that is at the most extreme overvaluation reading ever. If the ratio approaches 200%, as it did in 1999, and a part of 2000, you are playing with fire, said Warren Buffett. What about the put-to-call ratio? The current reading is 0.40. The dot-com bubble reading was 0.39, almost identical to the mania that we are experiencing right now. What about the margin debt to cash? The current reading is 172%. The dot-com bubble just before the pop was reading 179%. We're getting very, very close here. And what about the Federal Reserve's assets? And this is according to Forbes magazine. They call it bullish. The current balance sheet is at $7.4 trillion. Meanwhile, during the dot-com bubble, it was $585 billion. And the reason why they're calling it bullish, because so far inflation has remained in check. But we know that's not going to happen the further we go. And lastly, in sentiment news, here is perhaps the most troubling one. Morgan Stanley warns record flood of retail investors are buying the VIX could trigger a huge squeeze. And recently we saw massive short interest in the UVXY, meaning that there are people who are shorting the volatility index. And this is the largest spike since the March bottom of last year. And we know last time when we saw the short interest in the UVXY reaching these extreme levels, we witnessed the crash of February 2020. And now, let's move on to the newest segment in this program, titled A Journey to Neptune with Tom Lee. And we are talking, of course, about your favorite analyst, Tom Lee. I know that you guys love this guy, and you think that he's a genius, he's the messiah, he's the all-knowing, because he called the rally in Bitcoin. And a lot of you happen to be crypto investors and fans of Bitcoin. But what you might not know is, perhaps you're too young or you are new to this game, is that there is no method to the madness of Tom Lee, who by the way happens to be an extraterrestrial creature from the planet Neptune, where stocks only go up and you can make bullshit as you go, no questions asked. Tom Lee, in essence, doesn't live in planet Earth. He lives in a completely different planet, and he tries to project what he sees in Neptune on our planet. New retail investors got introduced to this guy during last year, and he indeed, among many others, called the bottom in March 2020 after the crash of the COVID-19 virus. And then he started making other calls which sounded cartoonish, outlandish, and unreasonable, but many of them came to life, such as the rise of Bitcoin, the rotation to cyclical names, and the rise for the market as a whole. And perhaps Tom Lee had a great year last year because it was the year of Neptune. According to that crypto witch on TikTok that we keep tracking, 2020 was the year of Neptune. So let's hear what Tom Lee has for us this year.
On the other hand, FundStrat's Tom Lee says investors are too cautious, and that has him keeping his bullish suit on. Let's bring him in, CNBC contributor Tom Lee, for more. You heard what Jim Cramer just said. He sees signs of froth that won't last. What do you say?
Well, I agree with him. I think there is signs of froth in the market in 2021. And some of the areas Michael Santoli mentioned, but these are, there were signs of froth every year since 2009. So I think one of the things we have to be mindful of is how pervasive that level of speculation is. It doesn't seem that high in our Zooms.
So it doesn't seem worse to you now than it did years ago?
I don't think this is. I think this is at a far lower level than even the biotech craze that was in that 2016 period.
And of course, his argument is that we're seeing outflow from some institutional investors out of the stock market, and that is not an indication of a top, or is it? If certain people, specifically the insiders, are pulling out of the market, perhaps they know something that we don't know. It's only dumb money that is flowing into the market, while smart money is actually leaving it. And Tom Lee, again, he's your favorite analyst. I understand that. But when Tom Lee gets something right, he goes into the media at CNBC and the likes, and he's touted as the Messiah, the all-knowing. But when he gets it wrong, which is the majority of the case, by the way, they just stay silent, and they hope that everybody's going to forget about it. And if everybody doesn't forget about it and brings up Tom Lee's bad calls, all of a sudden he would say, oh, but the connection with Neptune, it has a glitch. There was a glitch with the connection with Neptune, and I could not read the fortune cookie for the market. So while we're at it, let's do Tom Lee's greatest hits, starting with the year 2008. Tom Lee's 2008 target, 1590. 2008 official close, 903. But once again, there was a glitch with Neptune. That's the exception. Perhaps he'll do better in future years. Here it is in 2015. I see double-digit stock gains in 2015, says Tom Lee. Let's see if that was the case or not. Here is the time from which Tom Lee made his call versus the close of 2015. The stock market went down 2.5% and had a massive crash during the Brexit crisis. More from Tom Lee's greatest hits. Strategist Tom Lee is bullish because he says Trump will be like Eisenhower and Reagan combined. And this was at 23rd November 2016. After Donald Trump was just elected, he predicted that Trump will be just like Eisenhower and Reagan combined. And this is why you should put your blindfold on and buy. Fast forward a couple of months later, and here is the same Tom Lee. Bull turned bear. Tom Lee says Trump as market danger. So I guess he's not Eisenhower or Reagan after all. And in 2017, Tom Lee went further by saying the market will end the year lower. We have a nominal GDP problem. Let's see how that worked out. Here are the market gains since Tom Lee made his call. The S&P 500 will close lower at the end of the year. The fact is, the S&P 500 gained double digits, over 11%. And we saw a massive melt-up rally after that. Here is more. Tom Lee expected 10% S&P 500 sell-off if volatility spikes. If volatility spikes, I should expect the S&P 500 to go higher? What a prediction. And remember that Tom Lee predicts the Santa Claus rally pretty much every single year. He did it in 16, 18, 19, 2020, every single year. By default, he predicts a Santa rally. And here it is. A 10% rally for the S&P 500 is possible by year end. Fund strats, Tom Lee. Let's see how this one worked out for him. Since Tom Lee made the call, the S&P 500 fell 11% or so, and then rebounded about 7.5%. But of course, Tom Lee is going to play the mental gymnastics and say, oh, well, the market went higher by year end by 7.5%. I was just off by 2.5%. There was another galactic glitch with Neptune, and we could not get the percentage correctly. But the market went up at the end of the year, just like I said. Meanwhile, the market actually went down 10% since his call. More fun with Tom Lee. Here's another year and another Santa rally prediction. Another Santa Claus rally is coming on stocks will grow another 3% before year end. Here is another one in 2018, which was not the year of Neptune, by the way, because Tom Lee made bad call after bad call after bad call, but this one lives in the books of history. His most notorious call ever. Pay attention to the date, January 28th, 2018. Tom Lee, stocks have gone parabolic and are sending a bullish signal for the rest of the year. And here's what happened. January 29th, one day after Tom Lee made his prediction, the stock market marked the top and we saw a massive crash to the tune of 12% or so. And he also said, just before the crash, the US stocks will likely run higher for another 11 years. Why not 10? Why not 12? Why 11? That's the mystery of Neptune. But here's another disastrous call from Tom Lee. The bottom is here, quote unquote. The potential for violent upside rally is substantial, said Tom Lee. What is the date on that one? October 31st, 2018. Let's see what happened. Since Tom Lee called the bottom, the market declined about 11% or so. And perhaps this is a good illustration to who Tom Lee is. Tom Lee makes a bold call. Expect stocks to rally Friday. And this time around, indeed they did. Stocks rallied on that particular Friday by 1.35%. But the point to illustrate here is this an analyst or fortune teller? How could anybody take this clown seriously at all? At all. His predictions and guesses are no better than yours or mine. They are as accurate as putting a blindfold on and throwing a dart in the dark. When Tom Lee hits, they tweet him as the Messiah. When he gets it wrong, oh, let's just keep it quiet, pretend that nothing happened, and let's cross our fingers and hope that people are not going to notice it. Well, we are noticing it right now. And I think Tom Lee's going to make a disastrous call during this year. He's going to make a complete asshat out of himself. And this time, his fans who started investing last year will know once and for all that Tom Lee is a scam artist, a fortune teller, and a complete clown. But perhaps after that, Tom Lee will finally decide to leave Neptune and migrate into Uranus. Moving on to the heat map analysis, and let's see what happened for the week. We're trying to figure out a theme here. Is there a consistent theme that took place in the market? Right away, the most notable theme here is the rise of the semiconductor names. We heard the news that the Biden administration is thinking about an executive order to fund new factories for these chip makers to manufacture here in the United States to address the global chips shortage. And right away we saw massive gains for names like Applied Materials up over 15%, Lam Research up 15% for the week. Even chip designers such as Nvidia, Intel, AMD closed the week with massive gains. The other evident theme is the weakness, or shall we say, the muted activities in big tech. Microsoft is the only outperformer here, but we saw muted action from Apple, Google, Facebook, Amazon, Netflix. No notable moves one way or the other, even though the notable decliner here, Amazon, losing over 2% for the week, perhaps some profit taking here after the earnings report was released. We also saw a massive surge for the retail favorite names, specifically the new IPOs. Airbnb closing the week almost 9% in the green, DoorDash about 12%. We also saw massive gains for Twilio, Twitter. Zillow was one of the biggest winners of the week after reporting earnings, closing the week with gains over 25%. What about the energy sector? The winner overall for the week. The majority of the outperformance came from smaller names in the energy sector, such as Occidental, Schlumberger, Valero, Pioneer, Marathon Petroleum, all scoring massive gains for the week. We also saw another theme here that Chevron and British Petroleum outperforming Exxon. This hasn't been the case for weeks now. Exxon has been outperforming both Chevron, and British Petroleum. This week, we saw more inflow into Chevron and British Petroleum versus ExxonMobil. Perhaps they're trying to push the laggards to catch up with the gains of Exxon. Another theme we witnessed here during the week is the rise of Bitcoin, and that helped Bitcoin names such as PayPal scoring over 10% gains for the week. Meanwhile, Square closing at almost 13.5% gains for the week. What about the decliners here? The most notable one is Tesla. While we saw outperformance from Square, PayPal, the names that are closely related to Bitcoin, Tesla, which purchased a massive amount of Bitcoin and released that news earlier in the week, actually finished down over 4%. So perhaps investors did not like the news that Elon Musk is gambling with the cash that Tesla has by buying Bitcoin. We also saw declines for PepsiCo, over 5%, because PepsiCo reported earnings, and we know that PepsiCo managed to outperform Coke during the pandemic lockdowns because their business is more diversified. But as we migrate into the reopening phase of the recovery, Coke will start to regain the edge. And we saw some outflow from PepsiCo, down over 5%. Meanwhile, inflow into Coca-Cola, which closed the week up over 2%. Similarly, we saw massive gains for Toyota, which announced their new electric fleet, Toyota closing the week over 6% in the green. And what about the ETF heat map for the week? The bulk of the gains came from the semiconductor names, ETFs such as the SOXX, the SOXL, the SMH, closing a massive week in the green. Gains of over 8% in a single week. We also saw gains in oil, the XLE closing almost 5%, XOP closing almost 8% in the green. Similarly, gains for small caps, although not as large as the semiconductor names or energy names. Likewise, we saw emerging markets catching a bid, unlike last week, specifically Chinese names, when we talk about the ASHR closing in the green by more than 7%, and the big boys, the MCHI closing about 4% in the green. Meanwhile, the FXI scoring some decent gains as well, closing over 3.5%. All in all, massive week for certain sectors in the market. But we have to notice this. We did not see massive declines in inverse indices. They were down, but not as much as they were supposed to, given the movement in the overall market. In addition to VIX proxies, we continue to see the actual VIX declining significantly, but VIX proxies held to their ground here, suffering some losses, but not as big as we would have expected looking at the chart of the VIX. The VXX down almost 4.5%, UVXY down about 6% or so. Meanwhile, the VIXM, the medium-term volatility proxy, was actually up over 4%. That is very notable, and you have to pay attention to what's going on here. We will discuss more in the charts analysis. Speaking of, let's start with the 15 minutes chart of the SPY. We talked about the wedge formation on Thursday's video and that we have a breakout imminent, up or down. And I told you that the likelihood is it's going to be to the upside, given the momentum and the appetite for dip buying. Right away, you saw the breakout taking place on Friday. We gapped slightly lower during the opening, but the market caught a bid right away, broke above the wedge consolidation pattern, going back to retest it for support, and then blasting higher. That was a very healthy pattern for the SPY. And if you were a day trader, once you saw that retest of the upper limit of the wedge and then bouncing higher, that was your signal to buy the market. And we saw massive gains, massive inflow at the end of the day. What about the daily chart for the continuous contract of the S&P 500? We talked about the bull flag pattern, the consolidation. Are we starting to see a breakout above the bull flag, forming the next leg higher? Perhaps we just started that process on Friday. We still have a slight negative divergence in the RSI. And remember, my call is the reversal is going to happen after a massive gap higher. We see a massive gap higher, and then we do the gap and crap thing, and we start reversing lower, and that would be the top for the market. This is how I see things for now, at least. Moving on to the Qs, what do we see here from a 15 minutes perspective? You see the vertical line indicating the start of the activities for Friday's session. We managed to flush lower during the first hour or so of trading. Very fast, very violent flushes down. But we caught support from where? From the trend line in yellow that I've drawn for you for weeks now. The algos are respecting the trend line to the penny. Of course, the algos, in addition to retail traders, doing a lot of dip buying and keeping the market going higher. Every single dip is bought aggressively. That is in itself a bullish signal for the market, indicating massive support and appetite for risk taking. And just like we saw with the SPY, a massive bid at the end of the day, pushing the Qs to close at all-time highs. What about the daily chart for the continuous contract for the Nasdaq? We pretty much fixed the divergence lower in the RSI, and now we're trading flat. We have recaptured the momentum. Furthermore, we're starting to see the bull flag pattern playing out, signaling the next leg higher. That is the read for now until we see a reversal signal, and I'm in particular looking for a gap and crab scenario. What about the IWM? Here's a 15 minutes chart. We saw two bear flag patterns playing to the downside, and we started the day way lower, gapping lower, but immediately, just like we saw with the SPY and the Qs, the IWM caught a bid. The dip buyers showed up, whether that is algos or retail traders, it didn't matter, because the end result is the IWM surged higher. And like the Qs and the SPY, also caught a bid at the end of the day, even though not to the same magnitude that the Qs and the SPY have enjoyed. And let's zoom out and check out on the daily chart for the RUT, the Russell 2000. It's a very steep pattern, but we could still climb higher and higher because we have a bull flag pattern playing out right now. And will the next pop take us to recapture the very steep upward trend line? That is the question, and I do believe that will take place during trading next week. Moving on to the Dixie, what do we see here? A series of higher highs and higher lows. The trend remains intact until we mark a lower low. But here's another way to look at it, and perhaps reading the tea leaves. Is the Dixie marking a bear flag pattern that is supposed to take us down? Because we battled during Friday's session, we battled the resistance level of 90.5, and the Dixie failed to capture that resistance line, turning it into support, and actually closed just pennies below that resistance line. But the question remains, are we starting to see a bear flag formation in the Dixie, indicating a downward move coming? Moving on to gold. This is the opposite picture of what's going on with the Dixie. Are we seeing a bull flag consolidation that would take us all the way to battle the resistance level of 1870? It certainly appears so for now, assuming the US dollar continues to slide. And what about the most important chart to watch? This is the one that will indicate and dictate the stock market direction from this point on. The most important chart to watch, the TNX, the 10-year Treasury yield. I've been calling an ABC pattern for a while now. We saw that playing to the penny. We're pretty much done with the C-leg. We can go a little higher, but we're done with the C-leg formation. And on Thursday, I told you that I'm seeing a bull flag formation going on here in the 10-year Treasury yield, and that would take us higher. Indeed, it did. On Friday, the TNX blasted higher and closed at about 1.2%. TNX could care less about the manipulation attempts from Jerome Powell. The 10-year Treasury yield is raising the middle finger to the Federal Reserve, saying, "You're not going to fool me. I am rising because inflation expectations are rising higher." And of course, the complacent creatures of the market right now would say that this is actually good for the stock market, because as the 10-year Treasury yield continues to rise higher, the stock market will go higher as well. Why? Because we are rising for good reasons, quote-unquote good reasons, behind the rise in 10-year Treasury yield. If that is true, then why did the Federal Reserve just admit that the unemployment rate is actually much worse than expected, and it's closer to 10% than the 6% that they have announced? So is it really true that the case here for the rise in the 10-year Treasury yields is that they're rising for the good reasons and we should not panic? Or is it rising due to fears of inflation. And while we're at it, let's take a look at the chart of the XLF, the ETF for the financial sector. Remember, if the prediction is that the 10-year Treasury yield will continue to rise higher, that will be bad for growth stocks, for the overall stock market, but in the long term, it would be good for the financial sector, specifically banks and regional banks. Here is the chart of the XLF. The top was marked during the 2009 crisis, and we've never recovered the highs from that particular bubble. We've got close in 2019, but we saw the COVID crash taking us lower. Before the COVID crash, inflation expectations started to rise higher. And of course, those expectations got crushed after we found out that the virus is in the United States and we have to shut down, etc., etc. We have recovered inflation expectations and now they are higher than they were back in 2019 due to the rise of money supply and other fiscal and monetary policies. Now the XLF has recovered its pre-pandemic highs and it also defeated the top from the global financial crisis, indicating that there is a massive upside here for the financial sector of the market. What about the VIX? We talked about the VIX, the bear flag pattern, and that started to play out during Friday's session. Massive declines for the VIX, yet it managed to close at exactly 20, the rating that everybody was watching. The assumption here is that if the VIX closes below 20, it would be the first time it does since the beginning of the pandemic, and it would signal that a massive rally is about to take place in the equities market. We're certainly seeing bull flag formations in the overall market, and the VIX is supporting that theory that we will have a massive leg higher. However, I remain skeptical here. I think that this is a bull trap, and we're talking about the bulls for the broader market, not for the VIX. I think we will hit a gap and crap scenario for the overall market, and the VIX could dive below 20 indeed before reversing and blasting higher. Much higher. Why do I say that? Let's take a look at the chart of the VIXM. This is the Midterm Volatility Index. It actually scored gains for the week, meaning that perhaps investors are seeing a rally in the short term, but the medium outlook remains intact. This is a bubble, it's going to crash, and we will see higher VIX readings in the future. And what about Apple? The bear flag remains intact until Apple closes above 138. What it's doing right now is waiting and waiting and waiting in consolidation pattern, inviting the bulls. Any takers, anybody wants to take us above 138? Can we find any momentum here? But nobody's interested in buying Apple so far. The earnings were good, but the valuations are too high and they do not support what's going on with earnings. Until sentiment changes and we see more appeal toward Apple from at least the retail investor, the bear flag argument is supreme here. And remember, Apple is the canary in the coal mine. What about Tesla? What do we see here for Tesla? It's been consolidating for about a month now, doing absolutely nothing, and the reason is we're seeing lack of options buying, specifically call options buying. The backbone of the rise of Tesla's stock last year was due to call options buying. We talked about the retail investor being seduced by other objects that are much cheaper and easier to trade than Tesla's options. And therefore, we're seeing Tesla trading flat, not doing anything at all, because Tesla shareholders have no incentive or reason to sell either. And the question remains very psychological. The technicals don't matter for this particular chart. It's all about the psychology. Was the 800 level an important one to defend here for Tesla bulls? Was it an attractive entry point for certain traders to buy call options and push Tesla for another leg higher? Or is there a lack of interest in trading Tesla because the stock is too expensive, options are too expensive, and there are better opportunities elsewhere from the Reddit crowd? If that is the case, it is just a matter of time before Tesla starts diving lower, because all of what the chart is doing right now is waiting and waiting and waiting, inviting new blood to take this chart higher. If this price level is not attractive for new blood to jump in, the chart will go lower and lower, trying to invite new blood to take this ride higher. Perhaps the 800 level is too much. Let's go down to 750. No takers? Fine, we'll go down to 700. No takers, we'll go down to 600, etc., etc., until we find a footing where the retail investor will become interested once again in Tesla's stock. And now, let's move on to conclude this video. What do we have in the economic calendar this upcoming week? On Wednesday, we have retail sales, very important indicator. We have industrial production, another very important indicator, specifically for inflation. And then we have the FOMC minutes from the Federal Reserve. On Thursday, we have, per usual, the initial jobless claims. We have the Philadelphia Fed Manufacturing Index. And then on Friday, we will have the manufacturing and services PMIs, in addition to existing home sales numbers. What about the earnings calendar? On Wednesday, the most notable earnings will be from Shopify, Twilio, Palantir, and QuantumScape. All of these names are very popular with retail investors, and they are very overvalued, so they will be very important to watch, specifically in terms of how will these stocks react after earnings, good or bad. And Thursday, we have Walmart, Trade Desk, Applied Materials, and Marriott. And of course, we know that AMAT has been surging parabolically the last few months, and on Thursday, we will have a judgment day whether the recent surge higher is justified or not. Marriott, and there's another important earnings here. We want to see how the recovery in China is going on. And on Friday, we have John Deere, one of my top picks. However, I'm not buying the stock because it is very extended and very overvalued right now. But John Deere is one of my top stocks in terms of the Biden stocks, the lower dollar stocks, the inflationary stocks. It hits all the sweet spots. And I'm crossing my fingers and I'm hoping that this name is going to crash after earnings. We'll give it a couple of weeks and then I'll open a position for John Deere. And lastly, before I leave you, it has been a very good year last year and it has been a very good couple of months so far, even though we're not through with February. But so far, we have been receiving plenty of love. From who? From Papa Jerome. Manipulating the market on our side, servicing Wall Street, and us, of course, because we are market participants. It's a rigged game, it's a rigged economy, and if we cannot fight them, we will join them. But Papa Jerome is demanding some love back. He's demanding and requiring your undivided attention. It is his day to receive some loving back. It is time for you to show Daddy Jerome how much you love him, respect him, and be a good, obedient, submissive little boy and girl. Just like how Papa Jerome likes it. He ushered the tsunami of liquidity, marking himself as the biggest sugar daddy in the planet. So I ask you the question, after all the loving that Jerome Powell has shown you, are you ready to show some loving back? I don't know about you, but for me, I'm swiping left on Jerome Powell and I'm not seduced by his deception.